Hi, I'm Cathy Curtis. Welcome to Season 2, Episode 2 of the Financial Finesse podcast. In this season, I'm talking about what keeps you up at night. And as investments and the stock market are right up there when it comes to things that people worry about, I'm going to talk today about sticking with your investment plan during periods of uncertainty. And let's face it, how much more uncertain can things get than they are right now? There are two key money concepts that I'd like to get across to you today that will hopefully give you greater peace of mind when it comes to investing. One is that you must invest a good portion of your savings in stocks in order for it to grow and last your lifetime. And second, how important it is to have a long-term view when it comes to investing. Now, I'm just going to take a brief moment and explain something, a couple of concepts that you'll hear me talking about a lot. When I say stocks throughout this podcast, I don't necessarily mean that you can go out and buy individual stocks. That's what you're going to do. Investing in stocks includes investing in mutual funds or exchange-traded funds as well, both passive index funds and actively managed funds. And when I say the market, I'm using the S&P 500 as a proxy for the market. The S&P 500 is a stock index made up of 500 of the largest U.S. companies. It's as good a proxy as any for the U.S. economy and for the concepts that I am explaining to you today. All right, so in order to accept these concepts that you must invest a good portion of your savings in stocks and how important it is to have a long-term view when you do, you have to understand and embrace the fact that investing in the stock market has risk, with a capital R. The way you know stocks are risky is by their volatility. Markets go up and down day by day, week by week, month by month. Sometimes they go down a lot, and for a longer period of time that is comfortable. But that's a characteristic of stocks, and it's what we must endure to get the higher returns that stocks reward us with over longer periods of time. So just to visualize this, contrast investing in stocks to investing your money in a CD. A CD's value doesn't fluctuate. You buy it knowing you're going to get a certain amount of interest, but currently you'll get less than 1% investing in a CD with no upside potential. So for example, if you invested $10,000 in a CD today at 1%, in 10 years, you'd have a little over $11,000. In 20 years, you'd have a little over $12,000. Contrast to investing in the stock market with the average 8% return. In 10 years, you'd have over $21,000. In 20 years, you'd have over $46,000. This is a perfect example of the power of compounding interest and why the higher return you can get from the stock market compounds exponentially over time. The greater return on stocks is particularly important when you take into account inflation. Inflation means that your living expenses go up year after year, and they'll definitely be higher in retirement. If you are earning 1% on a CD and inflation is 2%, it won't be long before inflation has eroded the spending power of the money in that CD. In contrast, if you can earn a higher return on stocks, it will outpace inflation and keep your spending power intact for your retirement years when you are no longer earning an income or a salary. When you pay too much attention to the volatility of the market, it's really easy to get scared and want to sell out to feel safe. This is a mistake because it is too hard to know when to get back into the market. While you are trying to decide, you will most likely, proven by many studies, miss out on the very best days and hurt your long-term returns. Many people, maybe even you, got scared out of the market in 2008 in the depths of the global recession, and you may or may not have gotten back in. Yes, it took longer than past recessions for markets to fully recover, but by 2013, you would have been back to where you were, and probably better off if you had rebalanced your portfolio when the markets dropped. According to Goldman Sachs, the 10-year annualized return between 2009 and 2019 of 15% higher than the normal is one of the highest 10-year returns since 1880. The typical 10-year return since 1880 is 9%. But again, it wasn't always smooth sailing in that 10-year 2009 to 2019 period. If you recall, at the end of 2018, there was a scary market crash of about 20%, but that has recovered quickly as well. Let's just look at this year as an example. When COVID was spreading quickly to the US in February, investors panicked, and their widespread selling of stocks caused the S&P 500 to go down 34%. Since March 26, however, the index has completely recovered and more. If you were one of the people that panicked and sold and watched the market go up, up, up since then, you're probably thinking, well, now it's overvalued, so I'm going to sit out longer. This isn't the way to run a sound investment plan. So how do you stick with your investment plan in times of great uncertainty? Well, the first step is to believe in your plan from the start. So let's take the steps. To make a long-term plan, it's important to write down the kind of lifestyle you want for the future, along with what expectations you have for the next 30 years, because that's really why you invest your money, to make sure that you have it when you need it after you retire and you no longer are able to earn a salary income. Your portfolio becomes your source of income along with Social Security, or if you're lucky, a pension. So you're making a plan to get there. And I have to say that most people I know don't want to reduce their lifestyle in retirement. And investing is one way to ensure that you don't have to. Secondly, you're going to implement the plan, which a big part of this is determining the amount of risk you need to reach your goals and invest accordingly. For most people, this means a majority of their money should be invested in stocks. But whether it's 60%, 70%, 80%, 90%, you need to stay with it, rebalance periodically, and ignore the short-term volatility. Lastly, you need to stick with it. No matter what, stay with your plan. Unless something drastically changes with the United States or global economic systems, history should be a comfort to you. Now I'm going to talk about why sticking with an investment plan is so important for women in particular. Unfortunately, the statistics show that women are more likely to have a savings shortfall than men in retirement. There are many reasons for this, including the fact that women get paid less than men for the same work, and that women are more likely to be in and out of the workplace because of family care needs. Therefore, they can't save as much as men over their lifetimes. Until these realities change, in order for women to close the savings gap, they need to have a plan, stay with the plan even in times of great uncertainty, save and invest more than you think they need to, and get over the fear of investing. Thank you for listening. Again, if you'd like to hear more from me, follow me on Twitter at Cathy Curtis, or on Facebook, I have a business page called Women and Money.